Ever played musical chairs as a kid? Imagine that, but instead of chairs, we're using houses. Instead of kids, it's the world's biggest banks. That's a super simple way to think about the 2008 financial crisis, a meltdown that almost broke the global economy. How did it happen? Let's break it down. It all started with home loans or mortgages. Banks were handing out loans like candy, even to people who probably couldn't afford to pay them back. These were called subprime mortgages. Now, here's where it gets tricky. Instead of just holding on to these loans, banks decided to get creative. They bundled thousands of them together, the good, the bad, and the really risky into complex packages called mortgage-backed securities. Then, they sold these packages to investors all over the world. They got rating agencies to stamp them with a AAA rating, which is like a gold star for safety. So, everyone thought they were buying ultra-safe investments. Pension funds, other countries, big-time investors, they all bought in, thinking they had found a money-making machine. The global economy was basically betting on the idea that everyone would keep paying their mortgages forever. But what happens when the music stops? In the mid-2000s, interest rates went up, and suddenly, millions of homeowners couldn't afford their monthly payments. They started defaulting on their loans one by one. Remember those safe packages of loans? They started to crumble. The risky loans inside were like a virus, infecting the entire package. Suddenly, these billion-dollar investments were worth almost nothing. Panic erupted on Wall Street. Major banks like Lehman Brothers, which had been around for over 150 years, went bankrupt overnight. The whole system was connected like a house of cards. When one card fell, the rest came tumbling down. The banks stopped trusting each other, lending froze, and the entire global financial system was on the verge of collapse. To prevent a total economic apocalypse, governments around the world had to step in with massive bailouts, using taxpayer money to save the very banks that caused the problem. But the damage was done. Millions of people lost their jobs, their homes, and their life savings. The Great Recession had begun. The biggest lesson from 2008. The global economy is built on trust. When that trust is broken by greed and reckless behavior, the consequences can be devastating for everyone, not just the people at the top. It's a powerful reminder that what happens on Wall Street affects Main Street. Thanks for watching, and don't forget to subscribe for more deep dives into the events that shaped our world.